The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, kicking off the month of October, Tuesday's trade featured plenty of green on the screen for various factors, with wheat, lean hogs, and crude oil leading the markets on the day Tuesday. Let's talk about everything we are watching from here at home in the U.S. with port strikes and watching the weather to issues escalating in the Middle East and much more. Joining us for market analysis today, Jacob Burks with agmarket.net. Jacob, good to talk to you again, buddy. How are you?
Man, I'm good. Thanks for having me on, Jesse. I appreciate it.
Well, I kind of set it up there. It just felt like the money flow into the broader commodity space Tuesday, grains, livestock, energies, metals, etc. A multitude of reasons why we saw good money flow kicking off the month of October, Jacob.
Yeah, I think that you nailed it right there. I mean, we can set and make a lot of reasons and justifications to what the market's doing. You can kind of do that every day, a little bit to an extent, but you're looking at a time of year where if you go back and look at, if you simply just look at the dollar index, the value of the dollar versus all the other basket of commodities, it really has a tendency on these quarters. If you go back and look at the end of June, 1st of July, all of a sudden you saw the downward move of the dollar. And now you get the start between yesterday and today of this upward move. And so there's a lot of investment opportunities, at this time of year, just for simply companies coming in and saying, hey, at the end of the quarter, we took our profits. Now we're going to reinvest and recalibrate what our investment looks like. And one thing that you'll also bring your attention back, it wasn't very long ago when we cut interest rates, right? So there's some more investable money. Maybe some of that money is coming out of some of these debt-related investments and coming over into something that they value as maybe a little bit cheap right now. And I think you can kind of look across historically and what we've seen in the last 5 years, and you can see that the commodity markets are what is more investable right now.
Well, and I think about this too. You mentioned this point to me before we went on the air, and I thought this was interesting. You could look at it through two lenses, I would say. It's kind of how you summed it up to me. You have on one side kind of the fundamental factors that we're watching in these markets, and then on the other side, you have fear in some of these markets right now. Explain that for folks who are listening in today.
Well, the simplest definition of volatility is the measurement of fear. And there's fear in the marketplace. And you can boil that up and look at the whole macroeconomic picture, geopolitical picture right now, and just say, hey, there's a lot of fear. Today, this is Tuesday, that we saw the Iron Curtain get breached. So and that's when things like that are happening globally. The first thing you do is you pull your quote screen up and say, where's crude oil at? What's going on over there in the Middle East? And so, you saw a lot of volatility. I think we were up 340, 350 at one point, backed off a little bit. So that's just showing that, hey, there's a dollar that can move like this in this marketplace in the crude oil. And that's pure fear of, hey, what's going on? Somebody brought it to my attention earlier. It was like, how many of these funds and how many of these traders wish they would have bought crude oil, bought the grains, wheat market as soon as we saw the Russia-Ukraine happen back, a number of years ago. And so I think there's a lot of people hey, they don't want to miss that next opportunity. They don't want to be on this next big geopolitical move. And, some of these are head fakes and to try to measure your investment plan off of some of these next big crisis moments. I think that's a big, a big scary job to do. The one thing I'll say from you is if your livelihood is based on the potentials of crisis, it is very important in these type of markets to make sure that type of move doesn't hurt you.
No, very, very true. That's a great point. That's what it comes back to, risk management, and we could dive in more on that here in a second. I wonder too, and I'm speculating a little bit. I'd love your perspective. Wheat was the upside leader in the grains, double-digit gains. We were testing some key chart levels here from September, especially Chicago and KC. Yeah. And I know a lot of that tied to talk that Russia could restrict exports. We have dry weather concerns there in the U.S., Argentina, a lot of places around the world. I wonder, though, too, with wheat, with such a focus, kind of centered close to the Middle East, I wonder if that maybe played a little bit of a role in some of the money flow into the wheat trade as a whole on Tuesday, Jacob.
Yeah, I think again goes back to fear. I mean, wheat's it's a commodity that is food based. It's human consumption product, right? More so than anything. And I think that whenever you start seeing Middle East issues, Middle East problem, they're mostly importers of wheat to those areas, and how does that flow through there? I think that bigger part of that wheat also has to do with Russia's dryness. I think that you have other countries, they're the larger import countries that are looking to import more. But you've seen that the European area, the EU, did not produce as much. They had some dryness and production problems. You're seeing the Argentina issues with some dryness down there. So I think every part of the world right now that produces wheat is on somewhat of a dry area. And I think that added to it, and then you add all the fear of the Middle East, especially that area going through the bombing with Israel and Lebanon and Iran. I think that added to it today. And market was just very. You look back too, and it's like which one of these commodities is most undervalued, if you will. And I think that the wheat market has been something that people have talked about, and I think just saw some money flow into it today.
In terms of corn and beans, we were a little bit quieter there today. We had the stocks report, of course, to digest from Monday a little bit more. Harvest progress is ongoing in the U.S., things like that. I know in the case of corn, we're trying to get above some key chart levels here. I know that 430 mark, we fell just a penny short of that on the day Tuesday. I know some folks been talking about that could be a key spot to open up some top side potential in D's corn. I guess from a row crop perspective, any thoughts there across both as we kind of opened up the month of October, Jacob?
Well, I would say, first of all, that the corn market did develop a little bit more of a bullish story. I mean, you go back and just simply do a little bit of math there and realize that they took 60 million bushels away from the beginning stocks number. What does it take from a yield perspective to make that up? It's like less than around a half a bushel per acre. So let's just say that the USDA, maybe they add to that yield number come October. That's something that very well could happen. And some of the reports that we're hearing could. Go back and look at the charts though on that December corn chart. I think 429 was the settlement. I'd have to blow the chart up a little bit to see exactly where that 100-day moving average is. But that's a number, that's a target. That's something that we've been reaching, looking at and setting some targets. So fundamentally, we had a little bit of help yesterday, a surprise in the corn market, and I think that's something that. You did see a very large short position still. I mean, it's not as near as big as what it was. We've chewed up a little bit of that as far as from the managed money goes. But we have to remember that sometimes it's not liquidation. The managed money is a net between how many shorts they have and how many longs they have. And so throughout all this, when you see the open interest growing, when that happens, that's new buyers, new players coming into the marketplace. So that's something that we had to have. On the back of our mind is it's not just liquidation of their shorter positions. It's also going into adding new positions there too. So something that, as much as the burdensome supplies that we have in beans globally, as much as the potential of having over 2 billion bushels, like there's people here that want to buy this market down here. And that's been a pleasant surprise. And so from the psyche of the farmer, of the producer, you have to realize that this may not be the big game changer, and we're going to go back to see areas that we've seen every year. But other than this is an opportunity that the market's giving us.
Jacob Burks with agmarket.net is our guest analyst here today on the show. Let's talk some risk management a little bit. We think about the fundamental technical picture over here, and then the fear that we've been touching on over here, and kind of you have to look at both. And you mentioned, this might be an opportunity for some folks here in this market trade as we move into the month of October. So from a risk management standpoint, it just feels like that harvest is a busy time. We maybe sometimes don't think about that, lose sight of it, but the way things are with the economics right now, you can't necessarily just set it and forget it because there's some opportunity here in the market. Maybe talk about that a little bit more, Jacob.
It's funny that today is the day that we got another move higher here. It's 2 days in a row that we've seen really strong moves in the corn, and I was talking to some producers about how we've lost value in put options, and I think that there's two things here. There's guys that didn't get a lot done that are now getting an opportunity, and then there's guys that have done a lot, and now we have to manage what we've already done. And a lot of this has to do with where your positions at are, what do you need to do logistically. So this is the kind of the hard time of marketing. Marketing in the middle of the summer is pretty easy whenever you just, hey, later on we're going to have to sell it, but now we have to actually do something with it. In managing your operation, managing your cash, your facilities, your grain, your storage, and your logistics, and when even your cash flow. So there's a lot that goes into like that end of year management. But the one thing I would say is, like, when you're using these put options and you're using these positions that benefit your brokerage account whenever the markets are going down, sometimes it's not better off for your operation. And so we're at that point now where we've lost a lot of that value, those put options, but the market's up 55 cents now from the bottom. So this is an opportunity to use those gifts that you have, that the market came back and gave you an opportunity to sell at a higher price. And that's what we have to make sure that we're remembering whenever we put these risk management positions on us. We managed the risk. The risk was down. Now the risk came off. So we have some opportunity. There's a difference between risk and opportunity, and now we're in the middle of an opportunity. If you haven't done anything and you're in that mode where, hey, now it's time to make some sales. Okay, now, and even if you look out there, the spread out to March is not as big as it was. It's not as much carry in the market, but it's still there. It's still strong. So it is paying you to use that bin, that new bin that you maybe built, or the bins that you have on your operation. Take advantage of that by going ahead and making some sales out there into those spring months.
I'll add to your thoughts as well. I think about this. I know sometimes I hear from producers who say, well, I don't really like to play the futures and options market. I just assume sell the cash and move on. But I don't think necessarily in the way that things are right now with the ag economy in general, that's maybe not the best move to take. I think it's something to where you could sell cash, but the opportunity to re-own things on the board, et cetera, could really play into your favor here in this window. Am I right in saying that, Jacob?
Yeah, and I think the best opportunity, or the best I guess use of some of those call options or re-ownership, or what are you going to do, is getting you to make the sales, right? So using some call options. So the biggest fear is the fear of missing out, right? So as a producer that maybe they're right at their break even or real close to their break even, and they know they should be making a sell. And that's the biggest question I usually get is, why would I sell it here? It's not above my break even. And, that's a good point. That's a valid point. The market doesn't care where your break even is. However, using some of these tools to give yourself an opportunity between now and the end of the year, between now and next spring, to give you an opportunity to benefit if the market continues to go higher from here. Really, if you look at the corn options, they're about as cheap as they've been. We talked about fear, and a lot of times when you get a lot of fear in the marketplace, it makes the options go up higher. They're a little bit higher than they were a couple of weeks ago, but relative to history, you got some pretty cheap opportunity in some of these options to get that re-ownership and strategy. And what we're talking about is we're using tools that like a call option that gives you the right to buy futures as it goes up. They gain value as the market goes up, so therefore you're re-owning the sell that you made at the elevator.
I think some of the same thought process probably should be used over in the livestock trade. Let's shift over there. And I know that obviously different outlooks, different fundamentals, but even some of the price action in cattle and hogs as of late has been a little bit choppy to some degree. And I know some folks are maybe a little more concerned that we could be running out of some bullish steam, particularly in the cattle market. So, I mean, with that in mind, I again would say some of the same thoughts can be used over in the livestock trade as well, right, Jacob?
Well, we went and made that big push down the 1st of August. Too many cattle on feed, going into feed. We've imported so many cattle. The market made an ugly, choppy trade that looked like it couldn't. Went back and tested lows from years of that. We broke a lot of technical support lines. The 4-year trend was breached, and the cattle market ever since then has done nothing but surprise us and wonder how in the world is it still going up. And so I look at that as something that anytime that you see that, when you're scratching your head, you're in a question mark, and you have risk still there. Yeah, it's smart to use make some sales or get some strategies in place. But overall, I mean, the box beef, the economy has still allowed for this marketplace to stay relatively strong. And so I think that until this box beef really rolls over and gives up, I mean, the Packers are still in somewhat of a decent spot. Cash market back up to 186. So it's been a surprising move. What kind of fears me is you start to see the feeder cattle kind of roll over a little bit. This is 2 days in a row of seeing that feeder cattle. It seems like feeder cattle in all these moves, it's kind of led the way. It's kind of led the direction. We're starting to see that in the feeder cattle. I think we closed slightly lower today, but this is 2 days in a row of it after having like a 9-day stretch of positive closes.
Oh, that's a good point. Good point. Hogs were a good bright spot on Tuesday, but even there, outside of that October contract, is kind of close with the cash index. But hogs, I mean, I haven't been too friendly for hogs for quite some time. I guess I would say your perspective as we get into the part of the fourth quarter.
I think a lot of the last couple of days in hogs has been, this flooding and what's going on over there in the southeast. I mean, there's a lot of hogs come out of there. There's a potential port strike, which would clog us up a little bit. But it seems like the hogs and cattle kind of had some West Coast plans to avoid that, most of that problem. The poultry is probably what will hurt worse in the export side of things. Hogs have been something that for a while you wonder, when are they going to just break and fall apart? And they've been very resilient. I think that exports in the hogs have been something great. I think China's stimulus packages in the last couple of weeks is something that kept us, and maybe it didn't give us a big spark, but it probably kept us from falling off. I think that you see a dead flat market like we've seen in the lean hog. I feel like it's been just kind of boring, and sometimes boring is okay. Sometimes sideways is all right until we get more fundamental news in this marketplace. And I just look as we go forward, looking at the complementary products of cattle. I mean, people talk about that recessionary plan when the market started. The economy showed that it was going to have a little bit of life, maybe non-recessionary, cutting rates. We've seen some really a lot of strength, maybe new highs in gold and S&P and the Dow all that same week. And then all of a sudden, the hogs didn't just turn around and crash after that. So I felt like that was a pretty resilient trade. So maybe we have a little bit more life in here as we go forward. If maybe this hogs and pigs report that we saw, maybe these inventories are maybe just a little bit lighter than what we showed there.
No, that's a good point. We'll have to see how it plays out. Final thoughts as we close it out here today. Again, a lot of great stuff. I think important reminders just to reiterate to folks throughout all these markets is that we can't control things we can't control. Right. We can control our bottom line and our marketing plan. And I think that's kind of at the heart of today's message, ain't it, Jacob?
Yeah, Jesse. I mean, the price of these commodities are hard to explain. I mean, I would have I would have bet against a stronger rally in the beans today, the way the beans traded. I mean, we were negative to start the day. We ended up rallying, went 8-9 cents higher at one point during the day in the soybeans. The point about that is like what you're talking about revenue, right? So it's like when you boil it all down in your marketing plan, it doesn't have to do just with price. I mean, you got to look at that what your revenue per acre is. All the time. I mean, and you're starting to harvest. I mean, I've talked to a lot of guys throughout the Midwest here that's gotten into corn a little bit, and it looks really, really good. And so sometimes that break even does not stay where it started. And if you're stacking on more bushels than you anticipated, you can feel a little bit more comfortable at selling at a lower price because that revenue makes up that difference. So pay attention to that as you go through your marketing, through your harvest season.
And if folks got questions, I know you guys have a lot of resources there with your team. How could folks get in touch with you, Jacob?
Agmarket.net, Jesse. We look it up, take a free trial of all of our intel. We'd be happy to talk to you and walk through a marketing plan with you.
Agmarket.net for more. Jacob Burks, always good to talk with you, sir. Thanks for joining us today on Market Talk. Appreciate it.
Hey, Jesse, thanks for having me. Appreciate it.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.